Okay, real life traders. Here we are today. It is what is today? Today's Wednesday, right? Because we win on Wednesday. Hope everyone has had a great trading day so far. It's June 28th, and we are going to be doing a presentation today on becoming a consistently profitable trader. So something I know a lot of people struggle with. I struggled with it initially in my trading. Took me years to become consistently profitable. So if you're not already there, don't worry about it, right? Everyone gets there at their own pace on their own time. But what we're going to do today is we're going to talk about what are the keys, right? What are the things that you need to know, that you need to implement? And that's the key thing of the keys, the key of the keys. The key thing is that everything that you're going to learn today or be presented with, you actually have to put into practice. And that is, again, and it all ties in, right? Because if you consistently put these things into practice, you will become consistently profitable. So everything is tied together. And we'll talk about it because it's also part of the trading plan, right? You got to have a trading plan. And if you don't have the trading plan, then you're already setting yourself up for failure. So all right, let's kick this off. So start living your best life, becoming a CPT. CPT stands for consistently profitable trader. Feel free, I've got the chat open here. I've got, so I know who all is here today joining me. So at any point during the presentation, please post your questions in the chat and I will answer those. So let's go. Okay, so disclaimer, got to have it, right? So everybody knows that trading carries risk. So it's your responsibility to understand the risks. Only trade with money that you're prepared to lose, and you're the only one pressing the buttons, right? So quick disclaimer there. Everyone knows that, and again, this presentation is intended for educational purposes only. But again, we're all adults. We all know that we're responsible for our own actions. So okay, how to become a consistently profitable trader, a CPT. Okay, so we're going to cover a couple different categories here. So first, we're going to talk about best practices. So one of the first things you can do and best things you can do is find a mentor, right? And now, not to make this sound like a sales pitch, but there are lots of one-on-one mentorships available, mentorship groups available through real life trading. I'm a mentor. So again, not to turn this into a sales pitch, not the intention, but I will just share with you from personal experience that when I started trading, I wasted a lot of money on worthless courses, indicators, anything I thought that was going to give me an edge and make me a better trader. And if I had just simply taken that money and invested it with a mentor and somebody who would focus one-on-one with me and my needs, I would have been much better off. My learning curve would have been almost eliminated because the amount of money that I spent on courses now, and you have to remember, all these courses, there's lots of people out there selling them. They're just geared towards the masses, right? They're not individually tailored to you. So highly recommend find a mentor. And if you haven't done an individual mentorship or a mentorship group, I do recommend it. Avoid the gurus. Okay. Again, you go on YouTube and you start searching for trading videos. Of course, you're going to find everyone from real life trading, but you're also going to find a lot of others. And there's a lot of these gurus out there who make outrageous claims like I turned $500 into $500,000, right? They are outrageous, and there's a reason, because they're not real. Okay, I'm not saying that has never happened, but it is. These people are out there and they are trying to entice you, trying to dangle that carrot to make you think that, okay, you come spend money with me. And believe me, a lot of these people will charge you, 10, 12,000, if not more. And you're just not going to get the education that you think you're going to get. So avoid those people making outrageous claims. Be prepared to invest the time, not just the money, right? Trading is like any other profession, takes time and effort to become a consistently profitable trader. Think about the hours and the reps that you have to put in to become proficient with trading, right? it's not any different than in any other profession, right? You don't wake up one day and go, okay, I'm going to be a doctor or I'm going to be an attorney. You have to go and you have to become educated. You have to put in those reps, the time. And again, trading is not a get rich scheme. If you think that you're going to get rich overnight, you got to find a different profession because it's not going to happen. So again, plan if you're going to pursue this as a profession, or even if you just want to do this just to generate income on the side, right? It's going to take time. Everything in life that is challenging is going to take time to perfect. So just be prepared for that. All right. So I already talked about this, creating a plan, right? And anybody who has listened to me and sat through my workshops, that one of my favorite saying is right there: those who fail to plan to fail. Okay. If you don't have a written trading plan, you are doing yourself a disservice, right? You are setting yourself up for failure. And there's a reason that 90% of traders who attempt this profession fail. So it all starts with having the plan. Then you have to have a morning routine. Every day you need to review that plan. So another thing about becoming consistently profitable is before you take any trade, know your entry, your stop, your targets, and also have a plan on when to move your stops, when you're going to take profits, when you're going to move your position break even, and your exit plan, right? If you don't have all that planned out, again, it's all in the planning. And so if you're not doing the proper planning, you are going to set yourself up for failure. All right, so continuing with creating a plan. Okay, really key thing, and I emphasize this with anybody who I work with: when you're placing an order, okay, when you're placing your order in your broker, be sure that you're always entering your stop loss, your profit target, as well as your entry, right? So it's called a bracket order, an OCO bracket, right? And the reason that you are doing that, the reason you want to create an OCO bracket, is that when you get triggered into that order, your stop and your target is immediately in place. So why do you have to do that? Well, you could have a catastrophic loss if, let's say, you lose power, you lose internet. Yeah, we all have our cell phones, but think about the stress and the pressure. Suddenly you get into especially like if you get into a short, right? And you get in short on something, and all of a sudden you lose, and you didn't put in your stop loss, and suddenly you lose power, right? Now you're scrambling with your phone. And I use my phone for trading, but I'm not as proficient on my phone as I am on a desktop. So simple thing to do, right? When you put together that order, include your entry, your stop loss, your profit target. Then once you get filled, you can always go in there and adjust within that OCO bracket without changing it. You can always adjust your profit target and your stop loss, right? Manually do that. But at least if you do it all at once, you don't have to worry about losing power or losing internet. And I know plenty of people who this has happened to. And, fortunately, none of them got burned very badly, but some, it was worse than they would have expected. And others just said it's not worth the pressure and the stress that you experience when that happens. All right. Risk management. It begins with an R. Risk begins with an R. Everyone here at Real Life Trading hopefully is using that R system. And I will tell you, when I first started trading, again, having made all the mistakes all new traders make, and I believe I made them all. One of the downfalls, or I should say pitfalls, that I experienced when I first started trading was I didn't understand the R system. I didn't use it initially. I was randomly picking out share lots, right? I would do 100 shares here, 200 shares there, 300, whatever it was. So my losses were all over the place. They weren't controlled. Right? Because if I was just doing 100 shares on one stock one time, then 200 another, there was no rhyme or reason. I was just randomly picking a lot size. And so as a result of that, my losses were all over the place, right? I could have $1,000 loss. I could have a $100 loss. I could have a $5 loss. I could have, a $2,000 loss. I was using stop losses, but because I wasn't using the R system, I could not control the loss. So, but what the R does, right, and I says it right there, don't randomly select your share size, and that's what I was doing. So the R value gives you a dedicate, you know exactly what your risk is. If the trade goes against you and you are unable to move your stop at all, and you realize the full loss, you know what that's going to be if you're using the R system. So you all should know this, but the R is basically take your whatever dollar amount your R is, right? And again, that R, whatever you choose for that dollar amount, should be a number that is not going to change your life if you lose it, right? You don't want it to affect you psychologically. You don't want to upset your trading mindset if it's an amount that really you're uncomfortable with. So the R value should be something that you are comfortable losing, that is not going to adversely affect your life, but you also do have real money on the table, right? So one of the things with paper trading is you don't have real money on the table. So you don't have that emotional connection to the trade, right? Whereas with trading with real money, you do. So choose an amount that is right for you. That's the bottom line, right? So let's say if it's $100 for your R, you're going to take your $100 divided by your entry minus your stop, and that's going to give you the shares. It's that simple. I actually just built that into a Excel spreadsheet. And so every single trade that I take, I plug in my numbers, boom, it tells me exactly what the shares are, tells me, and then I place my order. So it takes it's an extra little step to do it that way, but it certainly does actually help in terms of taking that time and putting into the spreadsheet your entry, your stop, knowing what your shares are, and then you place your order. Okay. Having loss limits. I've gone over this before in my presentations on having a trading plan. You need to have maximum loss limits. And what they are is if you, there are amounts that you set for yourself, whether it's a daily, a weekly, monthly amount, that if you hit that loss limit, then you have to stop trading. So what it does is it prevents you mainly from blowing up your account, but it also keeps you from going down that psychological rabbit hole of then suddenly becoming hesitant to click the buttons because you've realized greater losses than you're comfortable losing. And so if you just have your maximum loss limits, so for instance, mine are 2R per day, no more than 1.5R loss on any one individual stock or trade, minus 5R per week, and minus 10R per month. If I hit those levels at any point, I'm done. So if, in the day, if I take 2 trades right out of the gates and I lose them both, and they're both full R losses, I'm done. I shut it down. Now, does that mean you just walk away and you don't have to, be at your desk? No, you can certainly, but you can then paper trade, right? You can watch the market. You can look for setups. You can do any number of things. You just don't trade, right? You just don't put more real money on the line because you just had a couple losses. It's going to mess with your head. It's messing with your psychology, your trading mindset, and you're going to then start to revenge trade. You're going to be probably taking trades that you otherwise wouldn't take because you're trying to make the money back. So have your loss limits, minus 5R per week, right? So if I hit that on, potentially I could hit that by Wednesday. If I hit that Wednesday, I'm done. 10R per month. Again, if I hit that, I'm done. I'm sure you've all heard the terms loading the boat and going all in. Don't do it, right? Why would you, right? Stick to being consistent, right? Loading the boat means you're not trading your R. That means that you are just throwing as much money as you can. Let's see. Albert's asking, how about, let's see, continue the trade with 0.1R after you hit your limit? Oh yeah, you mean like taking a partial, right? So like taking off like 90% at your, is that what you're saying? Taking off 90% at your target and then letting the additional, after your max loss. How about you trade with 0.1R after you hit your limit? Look, Albert, you can come up with your own set of rules, right? Mine are set in stone. These I cannot adjust. For me, I hit my maximum loss, I'm done, right? I don't, I guess, again, that's why everybody has to have their own individual trading plan, right? So if that's what you're comfortable with in your trading plan, that's fine. Put that into your trading plan, right? So what Albert is saying, what about if you hit your maximum loss, maybe then you just reduce your R to point 1 R after you hit it. Then what at that point, 0.1 R, I don't know, is that significant enough of an amount to really keep you in the game? I don't know. Albert, that's something you would have to answer for yourself. For me, I hit my maximum loss limits. I'm done. Right. Probably for training. Yeah. Again, I mean, you'll have to think about that. Right. And if you're comfortable having that into your plan, great. Right. So for me, I just know I hit those numbers and I just want to shut it down, because sometimes it's best just to shut it down and take a break. Right. Decompress. Let your mind just settle down, right? And stop thinking about the losses. Because at that point, 10-hour loss, right? If I'm hitting a 10-hour loss, I'm not feeling good. I'm not, my mind is not in the right mindset for trading if I've hit a 10-hour loss. So at that point, I do want to just take a break, right? And, go get kind of just, regroup and then get back to it. Keeping a trading log, key thing. Whether you do it in a spreadsheet, I do my note there. I do it in OneNote. So in OneNote with Microsoft Office, I actually would do a screenshot of of the chart. I then put in notes. I do kind of an overall summary. I write down what worked, what didn't with the trade, what I should do better, learning points, right? So I'm always trying to learn from every single trade. And so I log that. And one thing I like about doing it this way is that you have a visual. So instead of just having a spreadsheet where you're putting numbers in, it has, okay, here's my entry, here's my stop, here's the result, and either was a win or a loss. Me personally, I'm a visual person, so I like to have that. I like to have that screenshot to reference, and then also the notes. So when I go back, and I can then basically back trade with my trading log, just go back through the screenshots, right? That's another form of back trading. All right. Very important thing, right? Don't be a puppet trader. So a lot of people out there just get in the habit, and especially like if you're involved in a like the All Access Trading Room, right? It's a great community. It's a great place to be. The traders who recommend the trades are all pros, right? They're all solid trades that they're recommending, but you need to learn how to trade for yourself. So if you are just taking somebody else's trades, you are not learning how to trade for yourself. So when I say don't be a puppet trader, yeah, it's fine to take the trades that the room puts out, but don't just blindly rely on those, and don't just follow those without looking for your own setups. You need to learn how to trade for yourself, right? So down the road, when if let's say you're not in the room that day for whatever reason, but you are trading, you need to be able to trade for yourself. So so learn your own setups, right? Look for your own setups. The Holy Grail, right? I already mentioned this one. I mean, again, I was absolutely guilty of this when I first started trading, thinking wrongly thinking that something out there was like the answer, right? So I was going to find something, whether it be an indicator, whatever it might be. There was something out there that was going to give me an edge and improve my trading. And it doesn't exist. And I spent a lot of money and time searching for it. There is no holy grail of trading. Okay. There's two things, right? Two things that you need to trade: price action and volume. That's it. That's it. Price action and volume. If you eliminated, and I'm going to get to it, that's part of this, but if you eliminate all the moving averages, you eliminate the indicators, all you need is price action and volume to trade. And again, I was very guilty of trying to find this holy grail of trading and looking for it. Does not exist. So stop looking for it. Stop spending the money trying to find it. So back to removing things from your charts, right? So one of the things I like to say is, trade naked. And I don't mean literally sitting in, your office naked, sitting down trading, but if you want to, that's fine. That's up to you. What I'm talking about is clean charts. Okay. Keeping your charts as clean as possible, not overloading them with too many indicators. And again, this is something that all new traders or many new traders are guilty of doing. And I was guilty of it too, because I would, I was throwing on the Bollinger Bands. I was throwing on the moving averages. I was throwing on RSI, MACD, whatever it might be, right? Loading up the charts. And then what you do is you spend so much time waiting for all those things to align that you miss the trade. Oh yeah, so Ray, price action. Sorry, yep, perfect. Price action, Ray, very simple. It's just the candles, right? It's so price action, and I used to get kind of confused by that too. Price action is the candles, right? You're just looking at the candles and you're looking for whether it be the patterns or certain movement, right? So the price action are the candles that are forming, right? So I think we all use candles, right? We're using candlesticks for our trading. But some people use line charts, some people use different forms of price action, to track it. But for us, I think the majority of us here are using just candlesticks. So it is just watching the candlesticks, right? The shape, the patterns, the way that price is moving, right? So that's the price action, right? And then volume, right? We all know that there's volume by time, right? So when you look at the volume at the bottom of the chart, right, that is based on time. That's giving you the amount of volume. I look at that, but then I'm also a huge fan of volume profile, which is giving you volume based on price action, or price, not price action, but volume based on price, right? So I'm looking at volume two different ways. I'm looking at it on, okay, how much volume was occurring at this particular time in the chart, and also at this particular price level. So price action and volume, all you need, okay? Again, when you're loading up your charts, I'm sure you've all heard the term paralysis through analysis, right? You sit there and you have so many indicators or things in your chart that you're waiting for all those stars to align, and then they don't. Or then when you finally are convinced, okay, it's you've analyzed the chart to death and it's right, and then the trade is already gone, right? You've missed it. Now you're probably going to chase it, which you never want to do. You don't want to chase it. If the trade goes, let it go, right? But by keeping your charts as clean as possible, then you're less likely to sit there and overanalyze things. And again, I did it. I would sit there and I would analyze. Everything needed to line up. And you know what? No, everything doesn't need to line up. Just look for your setups and take them. It's that simple. Let's see. Okay, and I already touched on, but let me break this down into another way to say it: leading indicators and lagging indicators. Okay, when I said that the two indicators that you need are price action and volume, those are leading indicators. Okay, that is real-time leading indicators. Everything else are lagging indicators, which mean that the lagging indicators need price action and volume to then present you with information. So what are you better off looking at? The leading indicators or lagging indicators? The lagging indicators only produce results after the leading indicators have done something. And again, leading indicators, price action and volume. Okay. I already talked about many traders will identify a great setup and they spend too much time analyzing it, and then all of a sudden they're ready to pull the trigger and the trade's gone. Okay. And then you chase it, and you don't want to do that, right? Because when you chase the trade, now you're getting in at if you're going bullish, you're buying too high. If you're going bearish, you're selling too low, and that messes up your reward risk ratio. So, try to keep it simple, right? Have your setups, whether it's the 10 EMA strategy or whatever strategy it is you're trading, just look for those setups. You see those setting up, take the trade and let it go. So already talked about this. All you need is price action, volume, couple moving averages, right? So we do have the 10 EMA strategy. So the 10 EMA, the 20 EMA, I do like VWAP, the volume weighted price. VWAP is one that the institutional traders trade around. So I do like that. So that is one indicator I do have mine. And then higher time frame EMA. So I will use the 50, 100, 200. Okay. And then for what it's worth, my EMAs are always the lower time, the lower number. So like the 10 and the 20, those are EMAs. And then once I get into the 50, 100, 200, I use the SMA. And that's just personal preference, right? You can use whatever you want. You can use all EMAs. You can use all SMAs. It makes no difference. Okay. So, your own choice. Let's see. Stock selection. Okay. Very key thing. So what you trade is as important as how you trade. So trading things like, and so for instance, I know sometimes, give me a second, I'm just gonna get a sip of water. So I know sometimes people will throw out some suggestions in the chat about a certain stock one day, right? Something that's gapping. But then you go and you look at the volume, the average daily volume, and it's like 100,000 shares. Well, that is not liquidity. You want something that you can get in and out of no problem. You want to trade liquid stocks, avoid the low float ones. Now, when I say low float, those are the ones that certain people out there who have trading groups, right? Not real life trading, certain trading groups out there who actually trade low float stocks. And the reason they do is because they're easily manipulated. You can push around price. So if you get a group of traders together, 50 or so traders, and all of a sudden, the moderator running the room says, okay, we're going to buy this. And then they all buy it, and that forces price up because it's a low float stock, right? It's easy to manipulate. Well, what the members don't realize is that the moderator, the person running the show there, is simply using the members to create liquidity. They're already in the trade. So when they say, okay, let's buy this at this level, they're already in it. And then the members pump it up, right? So all of a sudden they all start buying it. That forces the price up. Then the guy behind the microphone is like, all right, we're going to sell it when it hits here. He's already out. So he's using the members to create liquidity, right? You don't want to be involved in something that can be easily manipulated. So good rule of thumb is average daily volume of 500,000 and ATR, average true range, right? I actually prefer more like 80 cents and up, but I'm certainly 50 cents. Sure. I mean, it depends on the ticker, right? I'll look at it, but something 20 cents, I'm not trading something that moves an average of 20 cents a day. Why would I? I'm not here to sit around and watch a stock all day to move 20 cents, right? Think about Tesla. Think about what that moves in a minute, right? I want something that's going to move. I want something that when I get into it, it gives me the potential to get the move that I want out of it and hit my target. But you have to think about that, right? Something that's only moving 20 cents per day. I'm not going to trade that. I really don't like to trade anything under $10. I mean, my sweet spot is anything, between like, for me personally, between like, let's say 30 and 150, something like that. I mean, obviously there are tickers out there that are more, but once you get under $10, I mean, you get down to 5. I mean, technically you're in penny stock territory, right? And especially if you're going to go short, right? Something under $10, where's it going in a day trade? So come up with some minimums for yourself, right? So again, ATR 50 cents plus, great. 80, even better. $1 plus, even better. All right, so let's talk about some characteristics of a consistently profitable trader. Okay, and this comes down to also creating your trading plan. You need to know your strengths and weaknesses, your risk tolerances, and a trading style that fits your personality. Right. So I'm not great at trading off a 1-minute chart. I'm just not, right? 3-minute chart, fine. But I'm just not, I know me and my personality and my trading style. And I know I'm more of a data-driven person. So when I'm looking to get into, a trade, like the chart, I just can't trade off a 1-minute chart. It's just not me. Could I in time learn to do that? Sure. But I'm good trading off a 3-minute chart, 3-minute, 5-minute, 15-minute, and then so forth, so on, right? But really for me, I've learned that the 3-minute chart is about the fastest that I'm able to trade. And that's just me, right? And I'm sure there are plenty of you out here right now listening and sitting here and who trade a 1-minute chart, and good, that's great, right? But that's your own individual strength, right? It's not my strength. I'm more data driven. So again, finding out, are you more suited for scalps, which I'm not, right? Scalping would be a 1-minute chart and being quick in and out. Or like me, are you more analytical, right? And I need more data. So, even like, when the market opens, like I typically, it's not that I won't get into a trade, in the first 15 minutes, I will, but more often than not, I'm finding my setups after the first 15 minutes, right? Because the first 15 minutes of the market gives me the data I need to make informed decisions, right? Because I'm not a good scalper, I know that. Know why you're taking the trade before you trade it, right? Before you take the trade, right? Don't just start clicking them out, open up a chart, give yourself, and you can set this into your rules, right? Write this down into your rules. Say, okay, well, I need to wait 5 minutes before I can take a trade, right? So whatever number you're comfortable with. But what that does is just, you see a chart, and I will give you a really good example of why it's good to take, don't just jump right in. So sometimes like I'll see a chart, I'm like, oh, great looking setup. I go and I got to stop myself and go, wait a minute, just take a pause, right? Because I might be looking at the 3-minute chart, and then I will then go to, I have another screen where I have 2 side-by-side charts, 5-minute, 15-minute. And all of a sudden I realize what looks really good on a 3-minute chart doesn't look good at all on a 15-minute chart, right? And I could show you plenty of examples where I look at something on a 3-minute chart and it looks like a great short, and I'm all set to go short. And then I pull up the 15-minute chart, and on the 15-minute chart, it's actually a bull hammer, right? So taking a moment to really understand why you're taking that trade, and then analyze it, right? And I don't mean analyze it until you miss the trade. I just mean take a moment. It doesn't take a whole lot of time to use your multi-time frame analysis and look at a higher level, a higher time frame chart to make sure that they're all in alignment. So what I like to do, if I look at 3-minute chart and I see something setting up, I'm going to look at it on the 5-15. Depending on the day, I might even go then from the 15-minute and 30-minute. So it all depends on the time of day. Earlier in the morning, for me, it's a 3-5-15. Later in the day, it's usually a 5-15-30. But what I'm going to do is, if I see something on the lower time frame chart, I'm going to take the time to look at it on 2 higher time frames. And if they're in alignment, if they all are showing me the same thing, great. But if I'm seeing something on the higher time frame charts that's contradictory to the lower time frame chart, I'm going to pass. Be aware of your mistakes. Okay, be aware of your mistakes, even if you have to write them down, right? And this goes back to your strengths and weaknesses. Be aware of your mistakes and make the necessary adjustments. Using sticky notes as a reminder, stick them right on your screen, right? There was a time I had a bunch of sticky notes. I'm pointing down, you can't see it, but I'm pointing at the bottom of my screens. I had a bunch of sticky notes here, right? So if there's something that you find that you're doing regularly, right? Whether you're chasing a trade, whether you're doing this, doing that, write it down, that sticky note, so that you're staring at it, right? Bring it to your own attention before you actually do it again. So these are more characteristics of a consistently profitable trader. So humility, okay? So be aware that traders will realize their greatest losses after having their greatest wins, their greatest gains. So what happens is traders who might have a series of great wins, right? And they, and all of a sudden they become, in a way, they become arrogant. They just go, oh, well, I've got this. I've got this down now. And it gets in your head, and then you start to feel invincible. So then you start making mistakes, right? You're not as disciplined as you should be. So what you need to remember is that market will quickly humble you, right? So stick to your plan. That's why you need to have a written plan. I'm going to say this over and over again. I'm going to be consistent with saying that you need to have a plan, right? So if you just have the plan and you follow the plan, then you're not going to find yourself in a position. When you have those series of really good wins and you have gains, if you stick to your plan, you're going to protect those gains. You're going to protect that profit. Being a lifelong learner, right? That is, like, I always say, I want to be the dumbest person in the room, right? Because if I'm surrounded by smarter people, that means I'm learning. I'm constantly looking to learn. When you think that you've learned everything, then it's time to stop, because there's always more to learn. I learn something every single day, right? From trading, from other people. So be willing to, okay? You want to have, it says you must possess the ongoing, voluntary, and self-motivated pursuit of knowledge. Always strive to learn. Always look to learn. Try to learn from all the people around you. We have some amazing, amazing people and traders in this community, right? And we can learn from every one of them. And I do every time I have a conversation, whenever I have the when I do the Talking Real Life Trading episodes, I always learn from the people who I interview. And so there's tons of people around that we're surrounded by every single day who we can learn from. And so, and again, here, as soon as you think you know it all, the market's going to give you a harsh reminder that you don't, right? So that's why you need to remain humble, right? Don't let some, a series of great gains get to your head. Just stick to your plan. All right. Discipline, self-control. So back to the plan. It all keeps coming back to the plan. You need to be capable of developing first. You have to have a plan and following a rules-based trading plan. Everybody who I work with, and if you've sat through my workshop on creating the trading plan, I always talk about how you want to be robotic with your trading. And the way to be robotic is to have such detailed rules that you can follow that just make it easy, right? Rules around anything and everything related to a trade, right? When you can move your stop, when you can't, things that, and then, and we'll get into it, but there, and having like if then statements, if this happens, then I'm going to do that, right? So having a rules-based plan that makes it easy to follow. And then that way you've got it. And you have to have that printed out. You have to have it on your desk, right? But you look at your plan, you follow your plan. And as long as you do that and you do that consistently, you will become a consistently profitable trader. The samurai, right? So we're all familiar with the Japanese samurai. They always said that the samurai always went into battle without fear. And that's how we need to approach trading. We need to approach trading like a samurai. Don't let fear control your emotions. You need to be in control of your emotions and don't get emotionally attached to a trade. If you lose on a trade, don't revenge trade it. Don't go after it. Let it go. Move on to the next trade. There's so many other trades out there. There's trades happening every second that the market is open, right? So you lose one, let it go. So be robotic in your approach. Don't allow your emotions to control you. So control your fear. We already talked about that. Samurai, control your fear, greed, and every other emotion that will rear its ugly head when trading. And it happens, right? Fear of missing out. We've all been there, right? I still get FOMO. It's not that I don't get FOMO. I do, but I don't allow it to control me. I don't react to it, right? When I do experience FOMO, I realize it's happening. I check myself and I let it go. And so that's just being in touch with your emotions, being in touch with your mindset, and being able to control that. Oh, look, there's me and Matt. Huh. That was back in Nashville a couple years ago. Funny. More about discipline and self-control. Okay. Oh, that was during COVID. That's right. That was our 2020 retreat there in Nashville. So discipline, self-control. A lot of traders, what they'll do is give you an example. Okay. They lose on a trade. They lose an R. Then they get into another trade and suddenly now they're up an R. And what do? They're like, oh, I'm at break. If maybe I should just exit. Maybe I should just, lock in this gain. And then that way I'm back to, break even on the day. You have to control the urge to exit a trade early and lock in profits. And especially when a trade is going your way. And in that example, you just had a loss. Now you're in a trade that gets you back to break even. And you just want to click that button and market exit and be like, whew, all right, I dodged that bullet. Now I can, reset. I just hit that reset button. I can start over. No, you need to, if you're willing to lose an R on a trade, you have to be willing to let it go to 2 or 3 R. And, we always talk about the holding muscle. That's the holding muscle. When you're getting into a trade, you need to be willing to let it do its thing. Now, there are some rules that you can put into place that will allow you to maybe exit a portion of your trade, right? So you can, but for the most part, in general, if you're going to be willing to lose an R on a trade, you have to be willing to hold and let a trade run. So one of the things that I always talk about and that I like to do is when I'm in a trade and let's say it hits whatever target I have, 2R, 3R, let's just say 2R. I don't take off the full position at 2R. I'll take off 90. If I'm still holding the full position at 2R, I will take off 90% of that position and I will let the remaining 10% run, right? Who knows? I mean, it could run all day. You never know. So I always like to just if there is a chance that it's going to keep running, I would rather still be in the trade, even if it's with a small position. Let it see if it can just keep going. So again, and that's right into my rules, right? So I can exit a trade at my target 90%, leave on 10%, and let that run. Already talked about not letting FOMO control your actions. Big thing that people will do is they see a stock moving and they didn't get into it and they're like, it's running without me, and then they just jump in, right? No, let it go, right? Even if it's making a monster move, right? Happens to me. Let's see, Brock, do I have the same stop with the 10%? Do I have the same stop with? Oh yeah, so Brock, typically at that point, right? So if I'm hitting, good question, and thank you for asking that. Let's say if I hit my 2R target, at that point, I'm probably already using a trailing stop. So I'm a huge fan of, like, if I get in on a trade on a 3-minute chart, and certainly if I'm over, let's say 1.2, 1.4R, right? Something like that, I'm more likely than not using a 5-minute 2-bar trailing stop. And I'll just keep doing that. I'll just keep moving my stop up as price moves up. And so, yeah, so that 10% that I hold on to, I'll just continue trailing the stop and let it run as far as it can. Okay. So I love that trailing stop strategy, and it 8 times out of 10, it works great. So it's just a very simple thing. Using a 5-minute chart, every 2 bars, count back, you move your stop, and you just follow price as it goes up. So if it does reverse, okay, then at some point you do get trailed out, right? You're not getting stopped out, you're getting trailed out. So anyway, don't chase a trade. If you miss it, just say, all right, well, I missed it, and move on. Consistency, right? Big key to consistency. How do you trail 10% from pre-close? How do I trail? Oh, so Albert, what I'm saying is what I do, and I can't show you now here, but Albert, at some point when I'm running the trading, ask me and I'll show you an example on a chart. But basically, Albert, what I'm doing is I'm using a 2-bar trailing stop. So once I get a bar that closes, right? If I get a bar that closes, and as long as it's making higher highs and higher lows, I count back 2 bars, 2 5-minute bars, and that's where I put my stop. And if the next candle makes a higher high and a higher low, then I count back 2 and I move my stop there. So and I'm giving you a very simple explanation, but that's how I do it. And it's a great way just to do a trailing stop. and you can let it run for as long as it will go. So avoid large equity swings by trading the same R each trade, right? Stick to the same R. Now, an exception I have to that rule is if I'm trying out a new strategy, I will allow myself to reduce my R to a half an R, right? Because it's a brand new strategy. I've already done back trading with it. Now I'm putting down real money on it and I want to test it out. So now I do allow myself to reduce my R to 0.5 R, and I'll do that for 21 trades, right? So that's my limit. I need to have 21 trades of a new strategy before I can determine whether or not it's a viable strategy. Because to me, anything less than 21 trades is just too small of a sample size to really be able to make a decision on that. So trading the same R, right? Don't trade an R, lose an R, and then go, well, I don't want to lose a full R on this X trade, so I'm only going to trade half an R. Well, now you need twice the win to make up for that full R that you just lost. So just always be consistent with trading the same R. Trade the same strategy, right? Don't bounce around. Again, what will happen is people will be like, I'm just not, getting, so I'm going to try a different strategy. You got to find something that works, right? I get that. So you do want to test out different strategies, but don't bounce around from strategy to strategy every other day, every week, right? Be consistent with the strategy that you're trading. So if you're trading the 10 EMA strategy, stick with it, right? Don't then go, okay, well, I've had a couple losses with the 10 EMA strategy, so now I'm going to only trade, hammers, right? Pick a strategy, stick with it. I mean, look, everything works. Jeremy's favorite saying, right? Everything works in the market, just not all the time. So pick a strategy, stick with it. Yeah, you might get a couple losses, right? But if you're being consistent with your trading with that strategy, the wins will come. Now, that's also not to say that sometimes with the market, strategies just don't work anymore, right? But you wait and the market comes back around and those strategies will be viable again. So you do have to be willing to adjust with the market as the market changes, okay? So remove variables and focus on systematic trading, right? And lack of consistency will lead to massive drawdowns, right? So lack of consistency can also be a lack of discipline. If you're not being consistent, if you're not sticking to your rules, if you're not following everything that you've put in place, it will lead to massive drawdowns. And the main key to trading is, yes, we're here to make money, but it's risk management. It's protecting profit. It is making sure that you're controlling risk, right? You control risk and you follow your plan, everything else will happen. Everything else will fall into place, but you have to be consistent with that, okay? Willingness to do the work, right? Again, I already touched on this at the beginning, that this is not a get-rich scheme. You have to be willing to put in the time, the reps, the effort. Trading is easy, but it's hard. Those who think that, and you'll find out, those that think that trading equals easy money, sadly mistaken, right? Sometimes it will take years for somebody to become consistently profitable. Sometimes it takes somebody 6 months. Depends on the person, right? We all learn and grow at different rates, but you have to be willing to put in the time and do the work. I already mentioned this about, becoming a successful trader is no different than becoming a doctor or an attorney, professional athlete, right? It all takes training. You just can't wake up one day and go, okay, I'm going to perform brain surgery, right? You need to go to school. You need to put in the time. And trading does require thousands of hours of practice, studying, and training, right? So that's, participating in the either a mentorship group or one-on-one mentoring, reviewing trades, back trading, taking the trades, studying, and just, and it's never ending. So it's, you just have to be willing to do the work. And if you're willing to put in the work and stick with it and be consistent, you will be successful. Ability to anticipate. This is, again, we're talking about characteristics of a consistently profitable trader. So ability to anticipate. Now, when I say ability to anticipate, I don't mean trading what you think is going to happen, right? You'll always trade what the chart is showing you. You trade what you see, not what you think. But you need to understand that, the market is a collection of people, right? Yeah, you could argue that there's, the computers, the high frequency traders, trading computers, algorithms, but keep in mind, all those algorithms are still written by people, right? They're still written by humans. Well, okay, maybe AI is going to change all that, but for now, right? But for now, all that code is written by humans. Is that going to change? Obviously, it's already in the process of changing, but it's a living, breathing thing that's driven by fear and greed. One of the reasons why I love to trade gaps, because gaps in the market create fear and greed. So fear and greed is what drives the market. So when I say anticipate, that's when I mentioned this earlier about having, if-then statements, right? So if this happens, then I'm going to do this. If that happens, I'm going to do this. So if-then statements should be built right into your trading plan. So I'll give you a great example, right? So yesterday, I think it was yesterday when Maloney was running the trading room. Anybody who was in there, I got into Amazon at the same time. Well, not at the same time. Everyone was the room was already in Amazon. I took a different setup, right? So the setup that I took, it was a short. I was looking to go short on Amazon, and I got a perfect entry. Price came up and it wicked in and it hit my entry and maybe just went a little bit above my entry and went right down. So the candle that triggered me in was a shooting star. Look, you can't get any better than that, right? You're looking to go short and you get triggered in on a shooting star. So my if then is, if I get that kind of an entry, if I get triggered in on a shooting star, right? And my theory on the shooting star is price should not get above that wick, right? So if it truly is an example of, the bulls pushing up and then them, getting rejected by the bears and it's selling off, price should not get back above that wick. So my if then is, if I get triggered in on a wick, I can then move my stop to just above that wick. If I get that perfect entry like that, I can immediately move my stop. So there's an if then statement, right? So having a series of if then statements as part of your trading plan is just going to help you, right? Because it helps you to anticipate, if this happens, then I can react by doing this. So again, I already talked about, not suggesting that you take action on what you think is going to happen. You always trade what you see, not what you think, but you should have these if then statements to help you react to the market movements, right? And I gave you, just gave you a great example of one of my if then statements. Okay, here's some other examples, right? Which will help you. And maybe some of these you can actually incorporate in your own plan. Okay, so if immediately after I enter a short, there's a high bullish volume spike on the 1 minute chart, then I look to lower my stop to avoid losing a full R. Okay, a little bit different than the previous example I gave you. This is just saying that if I enter short and immediately there's a huge volume spike, bullish volume spike, then I'm going to look to lower my stop to a level to at least help me to avoid losing a full R. Okay, if after entering a long trade, price makes a strong move in my direction for 2 to 3 bars, then I will look to move my stop to break even, right? So let's say, again, I nail the entry and immediately it goes in my direction several bars. I'm going to look to move my stop to break even as quickly as I can without risking getting, wicked out or trailed out. If after entering a trade, price quickly runs to my 2R target, I mean, let's say you get into a trade and boom, it just skyrockets, right? To can explain volume a little different. Sure. Yeah. Yeah, absolutely. Right. So I'll just finish this. So let's say you enter a trade and it immediately runs to 2R, like within a couple of candles. I'm not going to exit the whole thing. I already mentioned that. And maybe I'll just exit half the position because at this point it's moving strongly, right? It's likely to continue moving strongly. So maybe at that point, then my if then is, if it runs immediately to 2R, I'll only take off half my position, right? And I'll hold the other half. So Ray's asking, can I explain volume a little deeper? Yeah, sure. So so Ray, what I'm saying is if in that first example here on the screen, if I enter a short, and so sometimes, Ray, what I'm looking for, especially in like if I'm going short, if I see if I enter into a short and suddenly there's a like huge volume spike, okay, yeah. So and let's say in this example, I'm saying that there's a whole huge bullish volume spike right after I enter the trade. Well, maybe my timing is off, right? Maybe I'm just entering the trade at the wrong time because suddenly there's this, a lot of bullish volume that's kicking in. All I'm going to do is I'm going to look to lower my stop. Doesn't mean I'm going to move my stop to break even. I'm just going to look to lower my stop so I don't lose a full R. So I'll give you a great example of what I look for on exhaustion volume. Okay. So let's say, Ray, let's say I'm in short on a trade and price is, making a nice move down, right? Decent sized candles. And then suddenly I get right near, as it makes a new low, I get a massive bearish volume spike, right? Suddenly the bearish volume just explodes compared to the previous. Like if you look left on your chart, right? So volume explodes right as it's making a new low. And it's bearish volume and I'm in short. I'll go into the 1 minute and see if I'll go in the 1 minute chart and see if that volume spike happened at that 1 minute candle at the low. And typically what that is telling me is that that is exhaustion volume. Okay. Another word, say capitulation, exhaustion selling, right? So that just means that, and usually it also will be a much smaller candle than the previous candles. So suddenly, as it's making a new low, volume increase, bearish volume increases exponentially or doubles, whatever. But you'll see the huge volume spike, right? And it's not a big candle anymore. It could be a smaller candle, it could be a hammer candle, but price isn't going lower, but there's a lot of volume. Okay. That is typically what I will consider to be exhaustion volume or capitulation. And conversely, if you are in a bullish trade, right, and it goes up and suddenly it's making a new high, and compared to the previous, let's say several candles, it's a very small candle, it could be a doji, and there's just huge bullish volume. To me, I'm going to go into a 1 minute chart. I'm going to look and see, did that volume spike take place at the very high of that move? And if it did, I'm likely going to consider that to be exhaustion volume. Does that help, Ray? Cool. Okay. Yeah. If you ever need me to explain that further or show you examples on a chart, let me know. It's, they're easy enough to find those things. But yeah, so exhaustion volume just means that whether you're going bullish or bearish, that there's a awesome volume picks up, but price isn't moving anymore. And that's typically exhaustion volume. So I gave you those examples. So those are the if-thens, right? And again, they don't have to be set in stone, but they do help you to anticipate and react to market movements. Okay. We always talk about this in the trading room, in the all access pass trading room. Be aware of market events such as the Fed meetings and announcements, right? The market can become very volatile. So you always, I use econoday.com, right? That's a great resource for, and I know there's others, but econoday.com, I will look at that every morning. I will look to see what kind of Fed announcements are coming up so that I want to be prepared so that if I'm in a trade, I can tighten up my stop, or maybe if I'm approaching a Fed announcement, maybe I just don't take a trade, right? If I'm close enough where I know I'm not gonna be able to get in and out, maybe I'll just sit on my hands and wait till the announcement is over. I'm sure everyone here has experienced the volatility of a Fed announcement on a Wednesday, and suddenly the market just goes crazy. Happened today, right? We were, looking at going bearish on stuff, and suddenly, the Fed came out. I forget what time it was, but then all of a sudden, boom, everything got very bullish. Okay, patience. So Jeremy likes to spell patience with P-A-Y, right? So patience, because it does pay to be patient, right? Don't force things. Trade your plan. Let the trades come to you. But when a setup does present itself, don't hesitate. Take the trade. Do it with enthusiasm. Don't trade out of boredom. Now, I know there are some people out there. As a matter of fact, we had this conversation. Natasha and I had this conversation a couple weeks ago in Talking Real Life Trading, where she's like, I'll trade out of boredom. Like I'm sitting there and I'm waiting, and I'll just be like, okay, well, I'm just going to take this trade, right? Don't trade out of boredom, right? Just because you want to trade. Look for the setups with the highest probability of success. That's the next bullet point here, right? So be patient. Sit on your hands if you have to, but wait for, and I've talked about this where I like to actually grade my setups. Like I'll look at a setup and go, okay, is this an A setup? Is it a B setup? Is it a C? And if it's not an A setup, and I'm maybe having not a great day, I'm certainly going to wait, right? It depends on where you are in the day or maybe the week, but you don't want to trade out of boredom, right? So look for those trades with the highest probability of success. Sometimes the best trade is no trade at all. Don't focus on the trades you missed. Look, again, I already talked about it. Look for the next trades happen every single second, right? So if you miss a trade, don't give it a second thought. Just look for the next one because it's going to be right in front of you. I do like to always point that those that keep looking back can't see the present or the future, right? So once a trade is over, you missed it, or you had a loss, put it out of your mind, move out. And that is one thing that a lot of new traders have trouble doing, is not approaching every single trade as a new trade or every single day as a new day. So a lot of times people will have a couple losses and all of a sudden they're like, okay, well, I'm just going to take a half an hour on this trade because I just had 2 losses. I don't want to lose another R, right? And you really shouldn't, because if you have maximum loss limits of 2R, you should be done anyway, right? At least I would. But what they'll do then is they'll be like, okay, well, I don't want to have another full R loss, so I'm just going to trade a half an hour. That is allowing the previous trades to affect and impact your decision for the next trade. You have to be willing to treat every single trade, every single day as a new trade or a new day. Don't let events, the previous trade or the events of the previous day, affect or impact your ability to make decisions for the current trade or the current day. Loss aversion, right? These are avoiding these psychological pitfalls. So a lot of new traders, they fear losing. They don't want to lose. But look, the realization is, as traders, we can lose more times than we win and be profitable if you do it right. And that means it comes back to being consistent with your R. If you're always trading the same R, you can lose more than you win if you're managing your risk properly, lose more than you win. So if you lose an R on one trade, but you're holding out for let's say 1.42R on the next trade, you hit it, you're ahead, right? And over time, if you add that up, you can lose more than you win in terms of numbers of trades and still be profitable. But you have to be consistent with the R that you're trading. So many traders focus on avoiding losses rather than acquiring gains, right? Don't worry about the losses. You're going to have losses. We all have losses. Every day, people are taking losses. It's going to happen. You create a tendency to exit positions early. I already talked about this, how that adversely affects your risk reward, right? You have a loss, then all of a sudden it's like you're in a trade and suddenly you're profitable, and that you get that urge to exit just so that you can escape the day at break even. Don't do it, right? You're in the trade to make it a winning trade, right? You lost an R, now you have to make more than R to be profitable. I already talked about it. If you're willing to lose an R in a trade, you have to be disciplined enough and have that holding power to hold the 2R, 3R, whatever your ultimate target is. And you can exit trades early. There are times that exit trades early. If it's not working or it reverses immediately after you entering, you should take necessary steps to avoid losing a full R. Let me give you a great example. So I don't know if it was last week. I think I was either I was running the trading room or I was participating in chat. But I got into a trade and I was looking to go bullish on the trade. I got a really good entry. And then price was just going sideways. It just was not going in any direction. It was just wicking up, wicking down. I forget which ticker it was, but the point is, it wasn't, and I held on for a while and it was just not doing anything. It would get, I would get, I was going bullish. So it would get below my entry. So now I'm, in the red, it would get back to break even. It would drop down and it was just going back and forth like that. So at some point, what am I going to do? Am I going to, if it's not working, if the trade isn't working, it's clear it's not working. My trading plan allows me to take the necessary steps to do something, right? To minimize that risk. So what I will do in a situation where the trade just isn't flat out working, it's in the red. If it does get back to break even at some point, I do allow myself, right? And this is again, that if then, if the trade isn't working, and let's say you can set a time limit on this, whether it's 15 minutes, 20 minutes, 30 minutes, whatever it is, if the trade isn't working, if the trade's not working and it gets back to break even, then I can take off half my position and see if it works, right? So what I'm doing there is I'm allowing myself to immediately eliminate half my risk. So if trade's not working, it gets back to break even, I do have an if then that allows me to take off half that position. And now I'm only risking a half an R. So if the trade doesn't work, it's a half R loss. I've mitigated risk. That's what trading is all about, mitigating risk. If it does eventually work, great. I'll make some money. But you do have to have, and this is down a little bit lower, but you do have to have a feel for the market, right? So if something's not working, you have to be able to recognize that it's not working and have some rules around what you can do if it's not working. So again, in time, you will develop a feel for the market, and you'll know when a trade just isn't, going to work or isn't working. And again, I've already mentioned this, you cannot become a consistently profitable trader if you're regularly losing a full R and then you exit winning trades at less than, I say here 2R, but it could be 1.4, whatever, for a while there, the way the market was, we were only hitting 1.2 on targets before things were reversing. Things are, I think, getting a little bit better now. I'm seeing more and more 2R trades. So again, that's just back to, you have to be able to adjust with the market. So more loss aversion. Okay. I already talked about it, but again, more bottom lines, you're going to lose more often than you win, but you will be consistently profitable if you are holding your winning trades. Okay. One thing that I always emphasize is losing is, look, we should all be treating trading like a business. So losing is the cost of doing business. When you're in business for yourself, you're going to, the saying, you got to spend money to make money, right? Taking a loss is part of business. So in a trade, losing is the cost of doing business. And what I look at it is like, I almost consider it like, if you go to a amusement park and you go to get on a ride, you got to pay for that ticket, right? Now, you may not have ever been on this ride before, and you have no idea if you're going to like it, but you got to pay the ticket to get on the ride. And you have to go on the ride to see if you like it. Trading's the same thing. Your R is your ticket to see if your analysis is correct. So however you need to look at it, but Tony talks about it, right? How you need to separate yourself from money. And so if considering the R, the cost of doing business, or the ticket for the ride, however you want to do it, so that you're not just thinking about focused on the money part of it, right? It's a thing that you have to part with in order to see if you're right. Don't revenge trade, right? Again, when you're revenge trading, you're putting the emphasis on the money that you've lost, right? Take the loss, move on to the next trade. I like to say that there are no mistakes in trading, just learning lessons, right? If you learn from every mistake that you make in trading, you're going to be a better trader. Becoming a good loser, right? Why not? Be a good loser. Take the loss. Be sure to put it in your journal, analyze a trade, analyze and look for the mistakes that you made, write down what you need to do better. And again, with detailed notes, that's what I like to do. And then move on to the next trade. Now, when you're logging your trades, you can do them certainly after each trade, but then you might be taking time away from the market that you don't want to take. But certainly you should be logging your trades at the end of every trading day. When you finally do shut it down for the day, you should be logging those trades when it's fresh in your mind, right? A couple of days go by, you're going to forget little details. So it's best to do it the same day, right? I will often emphasize that a good trade is not always a winning trade, right? People are like, well, what do you mean? Like if I made money, that's a good trade. Not necessarily, right? Follow the process, right? The key thing is the process. If you follow the process, the results will come. So the process is more important than the results. And if you did have a winning trade, let's say you have a winning trade, you're profitable, you made some money, but you broke your rules, right? You broke your trading plan, then it's not a good trade. Just because you made money doesn't make it a good trade. If you made money and you broke your rules and you didn't follow your trading plan, it's not a good trade. But if you have a losing trade, and some of my best trades ever were losing trades because I stuck to my plan. I stuck to my rules. I didn't allow fear and emotion to control my actions. I stuck to my plan and I executed the plan, and I still lost money, but I felt good about the fact that I stuck to my plan and I didn't break my rules. Ignoring the peanut gallery. Now, I will emphasize that, as great as, look, this community is fantastic. It's great. Sometimes it's difficult for a new trader when you're seeing people posting in Slack about all the money that they're making and all their, big gains. And I had a 10-hour month, a 20-hour month, and, and you're struggling. That can be difficult, right? Because then you start doubting yourself. You start wondering, well, why are all these other people making money and having great gains and I'm struggling and I'm having losses? Do your best to ignore others in terms of their successes, because you're only competing against yourself, right? You're not competing against all the other people in Slack. You're competing against yourself. And it might be easier said than done, but you need to realize that this thing that you're trying to accomplish here, this trading thing, it's a individual pursuit, right? So don't compare yourself to others. When I say ignore the peanut gallery, when you're placing a trade, right? Don't let others try to influence you, right? So, because again, your trading plan is going to be different than others. So if you have a trading plan and you might throw out a trade idea and someone's like, no, I don't really like it. You know what? Or it doesn't fit my trade. Okay, that's for them. But for you, if it fits your trading plan and fits your trading style, take the trade. So when I say ignore the peanut gallery, focus on yourself, right? I say all too often NDT, a new and developing trader. That's what that means, that acronym, new and developing trader. Will identify a trade that meets their plan, but allow someone else to talk them out of it. Or worse, they'll exit a trade early on the advice of someone just to watch a trade run to target, right? And, and I've been there, right? I've had people talk me out of trades before and only to sit there and watch the trade work exactly as I thought it was going to work. So back to don't become a puppet trader. You also don't want to allow others to influence your decisions, right? So if you see a setup that fits your trading plan, take it and don't let somebody else talk you out of it. I already talked about this, right? Basing decisions off one or two trades. You can't do it. You need a large enough sample size to be able to make a decision as to whether or not a certain strategy is viable, right? So if you back tested or paper traded the new strategy, like here, I say to take 20 trades. Again, I bumped that up. 21, by the way, is my favorite number. There's no rhyme or reason for why I use 21, just because it is my favorite number. But also, I have read, like, when people talk about, if you're going to do something that's, to become consistent, right? Or if it's going to become a habit, 21 seems to be the number of days that keeps popping up. So anyway, do whatever number is comfortable for you, but it has to be a large enough sample size for you to really be able to evaluate whether or not the strategy is viable, right? So taking a couple trades on something and then going, doesn't really work. It's not enough, right? You can't take 4 or 5 trades and then have that and then base a decision on that. You need more, and you need to be able to, it says right there, commit in advance. You need to be able to, have a set number in advance and be willing to commit to that. Already talked about this, not approaching every day, every trade or every new trade every day as a new day, right? You can't control the market, and every moment in the market is unique. I mean, you think about it. No 2 trades are ever going to be identical, right? No 2, you might see similar setups, but no 2 trades are ever going to behave the same, right? So I already talked about this. Trade what you see, not what you think, right? Don't think a trade setup isn't going to work just because the last one didn't. Again, approach every trade. Every trade like it's a new trade. Every day like it's a new day. Remember, the market's going to do what it's going to do. So trust your analysis, take action, and be patient. And again, don't allow a previous loss to influence your decision on taking the next trade. So there's a person named, he owns a prop firm here in New York City, Mike Bellafiore. I don't know if does anybody here know that name? Mike Bellafiore? Okay, yeah. He's written a couple really good books, right? One's called The Playbook. Yeah, for sure, William. I'm gonna post this in Slack. Yeah. So Mike Bellafiore owns a prop trading firm here in New York City. I've actually visited the firm. I've been there. I've met Mike, met his team. There was actually a trader who was part of Real Life Trading at one point, who was a moderator who worked there for a period of time. So anyway, so one of Bellafiore's favorite statements is, "You can be better tomorrow than you were today." And I believe that 100%, right? If you focus on, and if you are really in tune with the things that you didn't do, that you didn't excel at today, the lessons that you need to learn, and you apply those to tomorrow, you can always be better tomorrow than you were today. So with that, I'm going to conclude the presentation. Great way to end it. You can be better tomorrow than you were today, in the words of Mike Bellafiore. So I want to thank you all for being part of this presentation on how to become a consistently profitable trader. I'll open up to some questions if there's any more. Sky, glad you liked it. Ray, glad you liked it. Yeah, I think the last time that I did this presentation was last summer. So about every year, I think I do it again, and it's a good one, right? Because, and we also, we get new people here at Real Life Trading. So to do this presentation every so often is probably, a good thing. So hopefully that was, this was helpful. Yeah, John remembers it from last summer. Yeah, but also John, right? I mean, yeah, it's a redo, right? But it also helps to reinforce it, right? All these things. Am I right? That, just hearing it again is something that just, helps to, like, yeah, for sure. Cool. All right. Well, I want to thank everyone. I'm not going anywhere. I'm just going to stop the recording unless there's any other questions, but no sense in continuing on with the recording. So I want to thank everyone for being with me for this presentation today on how to become a consistently profitable trader. Wish all of you the best luck in your trading in the future. All right, we're just going to stop the recording.